Analyst Gerard Cassidy expects encouraging results ahead. He is the head of U.S. Bank Equity Strategy at RBC Capital Markets. Gerard, also always great to see you. Bank of America is one of your top picks here, and so I got to start off with that, Gerard. What are you seeing in this earnings release, and what makes you pick the laggard of your group as one of your top picks?
Thank you, Melissa, for having me on the program. And the reason we like Bank of America is that it has a very strong core funding base. And this core funding base is going to be very beneficial to them as the Federal Reserve keeps short-term interest rates elevated, probably for an extended period of time. And if we are going to see a Fed funds rate, stay above 5% for 2024, banks like Bank of America will benefit from that because of this strong, cheap core deposit funding base.
Gerard, it's Karen. Thanks for being on. I have some Bank of America. I actually have a bigger bet in JP Morgan. I just felt like they did a much better job managing their book, their held to maturity, and then obviously they were the place to go to for deposits. And Bank of America has been sort of disappointing. The PE is really low, and they had a little bit of a held to maturity issue. But do you think they can get what do they need to do to get to a multiple that's at least double digits?
Hi, Karen. You're right. They have certainly had an issue with their held to maturity portfolio, particularly in their bond portfolio. And what I would suggest is that if the Federal Reserve is going to hit its terminal rate for Fed funds, possibly in the next 2 or 3 months, what we're likely to see for all the banks is that the deposit rates for the industry tend to peak 3 to 6 months following that terminal rate. And if that proves to be the case and the long end of the curve stays between, let's call it 3.8 and 4.25%, that's very positive for Bank of America. And the held to maturity, bond portfolio is going to over time pay down, and that will benefit them as well. But that's been the big, I would say, holdback on their performance this year is that underwater bond portfolio.
In terms of stock performance, the flip side of JP Morgan is State Street, which was an unmitigated disaster last week. We talked about it. It's probably down close to 20%-ish since they reported. Is that State Street specific, or does it portend something a little more dire for the space?
Guy, it's a good question because you're right. Their numbers, when they came out on Friday, really gave the stock a shellacking. And it all, I think, had to do with the fact that they guided down quite severely on their net interest income. As you know, State Street's a custody bank, and their customers are not grandma and grandpa type of depositors, but financial institutions. And as a result, they have to pass on almost the entire Fed funds rate increase to those deposit customers, and therefore they are now guiding down on net interest revenue. However, when you think the Fed is going to start cutting the Fed funds rate, which is not near term, I understand that. But when you think that could happen, State Street and Bank of New York will be the two banks to own going into Fed fund rate cuts because they will cut their funding costs more quickly than companies that have those core deposits like Bank of America.
Gerard, we are going to get a lot more of the regionals, a look at the regionals next week. And I'm wondering, because you say that the coast is clear, that there aren't any more bank failures to come. What will you be listening for in some of the regional conference calls to give you some more evidence of that?
Melissa, you said it well, because, those failures we saw in March and then, of course, the failure of First Republic in May were very idiosyncratic. What their deposit mix was totally different than the typical bank. And so we don't see any types of deposit problems like that for the rest of the large banking industry. But what we are expecting, as rates have risen here, banks are going to be using CDs or term funding for more of their deposits. They need to do this to keep their depositors happy, as well as the deposits leave the non-interest bearing accounts, they need to go into alternatives. So that's what's going to put pressure on the margin. This quarter is going to be very difficult for the regional banks on the net interest margin. But once again, should the Fed reach this terminal rate in Fed funds and deposit rates cease to go up by the end of the year, the regional banks will be in good stead going into the first quarter of 2024.